There are four possible outcomes on expiration day when trading call options. And in this video, you're going to get a walkthrough of all four with examples. Let's do it. For all these examples, we're inside Interactive Brokers Trader Workstation in our options chain right here. We're looking right now to buy a call option at 555 with the current price of the SPY hovering around the 557 level. So if we buy this call option and it's going to cost us about $18.06 times 100 shares, which means it's going to cost us $1,800.06 because every option contract, as you may know, is made up of 100 shares. So I've put the call option information onto this super chart. We've got the line in yellow here representing the strike price that we selected at 555. We have the cost shown right there for the one contract. And then we have our expiration date shown as the flag right here all the way on April 17th. And that's the day in question about if we're going to have to do something or not. It's on that day where the flag is. So if the value of the SPY just decides to kind of slowly make its way up and meanders up, and on expiration date, let's say it gets all the way up to $600 right there, and that's where it stops on expiration date. That's a good thing for us because we're going to make some money. And if this is our scenario, we have two actions, which you can see I just added to the screen right down here. We have action number one, which you can do is exercise the contract, or we have action two, which is close the contract. So we have to do something. And if we go with action number one and exercise the contract, what we're going to be doing is this. You'd go into your portfolio, you'd click on this call option because it'd be showing a nice unrealized profit, and you would go exercise. And what that's going to do is going to allow you to buy 100 shares at this 555 strike price. And then when they're in your account, you can go ahead and sell them on the open market for $600, giving you a pretty nice lift and a profit around $5,500. And if you're more of an action two type of person, closing the contract, what you're going to be doing is going into your portfolio. You're going to locate your actual call option of 55.5 that you actually bought. And you're just going to go in there and you're going to click close position. It looks something like this. I'm into my portfolio and I'd have a call option here that I bought. Let's say this one's showing a negative loss, but you'd go in here. Let's assume it's positive. We're going to right click on it and you can click on close position. That's going to bring up your order. You could then go and just sell it off to close it off, submit that, and lock in your profits that way. The main thing here is that you can't just sit back and let the option expire on expiration date. You actually have to actively make a choice and do something. And if you do just let it expire, it's going to take all your profit that you have and it's going to become worthless. So please understand if you have a call option that's profitable, this is a very good scenario in case the price moves this way, you have to be active on expiration date and close this contract off or exercise your call option, get those shares in your account, turn around, sell them for profit on the market, and become a winner. Now, let's say you buy this same call option here again, but this time instead of the price going up like we want it to, the price keeps going down, 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 fading lower, and ends up right around that 500 mark on expiration date. What happens now? So in this scenario, the reality is you're going to be losing some cash. You just have to accept that. The actions you have right there are action number one, close contract and expiration date, or you have action two, which is do nothing. So because this price went down, which is the opposite of what you want to have happen when you're buying a call option, there's going to be an unrealized loss shown in your account because of this price movement. And that's fine. It happens sometimes. If you wait to the very last day on expiration date for this and you want to have an action, you could close the contract off just like I showed you in the previous example, doing the exact same thing. Instead of closing it off for profit, though, you'd be closing it off for a loss. Now, if you close your contract on expiration date on the very last day when it's going to expire, it's probably pretty likely that the contract value is going to be close to nothing. So this 1806 is probably going to be worth like 0.05 or very, very little. So there's actually not really much point in closing off the contract at that date if it's gone this far against you. So in that case, you could just sit back and do nothing in action two, and it's going to automatically give you a max loss scenario. But again, the good thing is if this happens down here, is that your loss is capped to this original $1,806 that you would have paid to open up this trade. And of course, we wouldn't want to exercise our contract because we'd have to buy shares at 555 and turn around and sell them at 500 on the open market. That's not something that you want to do either. So you just accept the max loss. You can try to close the contract for a smaller loss. But again, if it's on expiration date, chances are doing action one or action two are going to be really close to the same results in a almost near or a full max loss of this amount right here that you originally paid in the beginning. Normally, the contract will be removed from your account the day after when everything settles, so probably the Saturday after it expires, and then you just go back to business and keep on trading. So that's buying call options. You got two scenarios there with a couple different actions that you can do. If we want to sell call options, be on the other side of things, we can stay on the call side, keep the same expiration date. Let's go down now to the 560 strike price and be call option sellers here. So it's highlighted in red. And we're going to have an option there to sell and get paid 15.11 or 1511, which roughly is about 1500 bucks in profit to sell this 560 call option. So as you can see, our expiration date when we're selling this 560 call option stays the same at April 17th. Our line just moves up a little bit because we've sold. And our premium now, it's not a fee or a cost, it's premium that we're getting paid because we're doing the selling. So we get paid something as the seller, the 1511 right there, or the 1511 total profit potential for this setup. And so let's say we've sold this call option and now the price of the SPY starts to tick up higher, which when we're buying is exactly what we want to have happen. But now as a seller, this is our worst nightmare. If the SPY ticks up all the way to 600 bucks in this example, we are in some trouble if this is your scenario. The big problem is that people sell these call options and they don't have 100 shares in their account, which is called an uncovered call. Very dangerous with potential unlimited losses. If you are selling this contract, I always recommend having at least 100 shares in your account at whatever price that you get them at to cover your position. And here's why. On expiration date, the buyer of this contract right here, right? You sold it, someone bought it. A buyer is going to make you sell your shares at 560. So you're going to sell them right here. Okay. But if you don't have any shares in your account and you do this uncovered, it's going to create what's known as a short. You're going to see negative 100 in your account and you're going to be short 100 shares, which is probably not what you want to have happen. In order to cover your short, and there are other margin impacts that may be required in this scenario, but to cover your short, you're going to have to turn around and buy 100 shares at 600 bucks, meaning you sold something for 560 and paid 600 to get it back. Man, you're going to be down about 4K on that trade if this was to play out. And the really scary thing is if it doesn't stop at 600, if it goes up to 700 or 800, you go from 4K, right? You can go up even higher. You can get up to 10K, 20K. Like the stock price of the SPY or whatever it is can go up infinitely to whatever number. So it's technically an unlimited loss scenario, which is a bad idea to do this as an uncovered call. But let's say for a minute that you're a responsible trader, and let's say you have 100 shares that you bought, I don't know, at the 530 level down here, and you ended up just waiting and selling a covered call a bit later on. Cool, good stuff. On expiration date, you don't have to do anything. You just let the call option expire, and the shares are going to get called away. You bought them for 530, you're going to sell them for 560. So that math checks out. That's going to be a profit for you on that. Plus, you keep the premium. So things are working out pretty well when you're doing it as a covered call or a CC, not an uncovered call, which I just explained in the previous example. So to recap, you've got two actions. One is for an uncovered call. And if this is your scenario and you choose to trade like this, you should have some kind of eye on the actual position. And if it starts getting wrong way and it's going up higher and higher and higher, have a look. Maybe time to close off the trade. And you can do that on expiration date or before, just understanding that the higher the price goes, the bigger your loss is going to be. So it would be advantageous potentially to set a stop loss somewhere. And if the price hits X number of dollars, close off the trade and take your losses and move on in that scenario. And if you're a nice responsible trader and you sell covered calls, you can sit back and just collect your premium and don't have to worry about anything. You lock in the 1511. You hopefully lock in some appreciation on the stock price moving up from where you bought it with your purchase, and things are gravy and you're doing really, really well, making money as a trader. And so now on the flip side, we've sold this call option. Yes, again, hopefully a covered call in this scenario. And let's say the price of the SPY doesn't go up, it goes down. And it's going to go down, down, down in an earlier round. Sugar, we're going down as the song goes. Let's go all the way down to 500 bucks and level off right there. Basically, As long as the price of the SPY is under 560, anywhere up here, it can be up here or down here, wherever it's going to be at expiration. As long as it stays underneath that price, you're making full pop. 1511 is going to be your profit as long as it stays underneath that. It can even go up above it quickly at the beginning and then slowly fade underneath it at expiration. As long as it's underneath it at expiration, you're making max gain, which is this number right here. If the SPY was to sell off super quickly, you may be able to kind of have a move like this potentially. You could close this contract off early and lock in a good chunk of this 1500, maybe not the whole thing, maybe 50%, 60%, something like that. But you could do that early potentially if there's a strong downward move again, like that. Otherwise, you're sitting back, you're waiting on it, and you just let the thing expire on expiration date. Nothing for you to do really. So if it moves in the right direction and keeps on floating lower or stays the same for a bit, then floats lower, I mean, you actually action one, just sit back and wait, collect your cash on expiration date. It will automatically expire worthless, as they call it. You'll get a nice tick in your account saying, yeah, you locked in this much profit. Awesome. Way to go. And you can go back and you can repeat this on the SPY next time it gets back up to this level or at whatever strike price you may see fit. It's pretty hands off and it's a good way to go if you're doing it with covered calls. Again, the other way is if it does have a pretty steep move right off the hop in the first couple days, you may want to close out your trade early. And you don't have to, but there's this thing called rotating your capital and finding better trades to do it with. So if you want to close it early, you absolutely can. You go in, you close it out just like I showed you earlier in the video, except this time you're closing it out for cha-ching, big dollars, and you're a winner in the stock market trading game yet again. So now that you know all the different outcomes on expiration date for call options, maybe you want to know why I, as an option trader, refuse to buy calls and only focus on selling. If that interests you, check out this video coming up right here. And if you got some video today, please subscribe to the channel for more info. Thank you for watching, and I'll catch you on the next one.